Imagine someone building a house who starts with the roof. No foundation, no walls, no support, just a roof, floating where the top of a house should be. You'd know instantly it was going to collapse. And yet, financially, that is exactly what most people do with their money. They chase the exciting part, investing, growing, building wealth, before they've poured the foundation that's supposed to hold all of it up. Today, I'll show you the financial foundation most people skip, the exact order it needs to be built in, and why doing the right things in the wrong order quietly sets people up to fail. Let's start with the core idea, because it flips how most people think about money. Financial success is not built from the top down, it's built from the bottom up. The flashy stuff, the stock picks, the wealth accumulation, the big returns, that's the top of the structure. But a structure is only as strong as what's underneath it. Before you focus on growing money, you have to establish protection, manage your debt, and build a reserve for emergencies. Skip those, and you're not building wealth. You're building a roof with nothing holding it up. Here's the problem, and it's not really the audience's fault. Almost all financial content out there focuses on growing money, how to invest, what to buy, how to get the highest return. Very little of it focuses on preparing you for financial setbacks, so people absorb the message that finance is all about growth, and they jump straight to investing before they're actually ready. Then life does what life does. An emergency hits, and because there's no foundation underneath, they're forced to take on debt, liquidate the investments they just started, pause their retirement contributions, or start completely over. The issue usually isn't that they made a bad investment, it's that they did the right thing in the wrong order. Let me make this concrete with the house analogy, because it's the whole video in one picture. Nobody builds a house roof first. You start with a foundation, then the structure, then, eventually, the roof. Each layer rests on the one below it. But financially, people do the opposite. They invest while still carrying high-interest debt. They buy stocks before they've saved a single dollar for emergencies. They race to grow their wealth before protecting the income and the family that everything depends on. The result is a fragile structure, impressive looking maybe, but one unexpected event away from coming down. The purpose here is not to discourage investing. Investing is essential. The point is that investing works best when it's built on top of a foundation strong enough to survive a storm. So let me give you that foundation as an actual structure. 4 levels, each one supporting the next. This is the order most people skip, and it's the order that actual holds. Level 1 is proper protection. This is the bedrock, and it's the one almost everyone ignores because it's the least exciting. Protection means shielding yourself against the major financial risks that could wipe everything out. It means protecting your income, because your ability to earn is the engine that funds your entire financial life, and if it stops, everything stops. And it means protecting your family and your assets, so that a single catastrophic event doesn't erase years of progress in an afternoon. Protection feels invisible when nothing goes wrong, which is exactly why people skip it. But it's the layer that lets every layer above it survive. You protect first, because there's no point building wealth you could lose to one event you never prepared for. Level 2 is debt management. Once you've put protection in place, you turn to the debt that's quietly draining your flexibility. This isn't about being debt-free overnight. It's about reducing the unnecessary debt, getting control of the high-interest debt that works against you every single month, and improving your financial flexibility so your money isn't all spoken for before it even arrives. High-interest debt is like a leak in the foundation. Every dollar of interest is a dollar that can't go toward protection, savings, or growth. Managing it doesn't just save money, it frees up room to breathe and to build. You can't pour a stable foundation while water is pouring out the bottom. Debt management is how you seal the leak. Level 3 is your emergency fund. With protection in place and debt under control, you build a reserve of accessible cash for the unexpected. This is the layer that creates financial breathing room, short-term reserves that let you handle a surprise expense or a gap in income without reaching for a credit card or selling your investments. The emergency fund is what makes everything above it possible, because it absorbs life's shocks so the rest of your structure doesn't have to. Remember those people who get forced to liquidate investments and pause retirement when an emergency hits? This is the layer that prevents that. The emergency fund is the difference between a setback being an inconvenience and a setback being a catastrophe. It's the shock absorber for your entire financial life. And only now, on top of protection, managed debt, and a real emergency fund, do you reach level 4, asset accumulation. This is the part everyone wanted to start with. Long-term investing, wealth building, retirement planning, growing your assets over decades. And here's the beautiful part. When you reach this level on a solid foundation, it actually works the way it's supposed to. You can invest for the long term and ride out market drops calmly, because your emergency fund means you'll never be forced to sell at the bottom to pay a bill. You can let your retirement accounts compound for decades, because your protection means a single event won't force you to drain them. Asset accumulation isn't the enemy of the foundation. It's the reward for building it. It's the roof that finally makes sense, because there's a whole house holding it up. Notice the pattern across all 4 levels. Each one supports the next. Protection makes debt management possible because you're not constantly knocked backward by uncovered disasters. Debt management makes the emergency fund possible because you're not bleeding cash to interest. The emergency fund makes investing possible because you can finally take a long-term view without panic, skip any level, and the ones above it become fragile. Build them in order, and each one reinforces the rest. This is why sequence matters so much. Financial success depends not just on doing the right things, but on doing them in the right order. Let me drive that home, because it's the insight most people miss. Doing the right thing in the wrong order actually creates risk. Investing is genuinely a good thing to do, but investing before you have an emergency fund means the first crisis forces you to sell at the worst possible time. Paying down debt is good, but throwing every dollar at debt with no cash cushion means the next surprise puts you right back into debt. The individual actions are correct. The order is what determines whether they build something stable or something fragile. A great move at the wrong time can quietly become a liability. And here's why this foundation matters beyond the spreadsheet. It changes how money feels. Emergency funds reduce financial stress. There's a real, measurable calm that comes from knowing a surprise won't derail you. Protection creates stability. The quiet confidence that your family and your income are shielded from catastrophe. Debt management improves flexibility, the freedom that comes when your income isn't all promised to lenders before it lands. Each layer of the foundation isn't just a financial mechanism, it's a source of peace. The people with a strong foundation don't just have better numbers, they sleep better. They make calmer decisions. They're never operating from desperation. There's one more payoff that almost nobody talks about. Wealth building becomes dramatically easier once the foundation is in place. When you're not constantly putting out financial fires, you can stay consistent. When you're not forced to sell investments during every downturn, your money actually gets to compound. When your income is protected and your debt is managed, more of every dollar can flow toward growth uninterrupted for years. The person with a strong foundation doesn't just invest more safely, they invest more effectively, because nothing keeps yanking them off course. The foundation isn't a delay on your wealth building. It's the thing that lets your wealth building finally work. So if you've been frustrated that your financial plan keeps falling apart, that every time you start investing or saving, some emergency knocks you back to zero, this is almost certainly why. It's not that you're bad at money. It's that you've been trying to build the roof before the foundation. And the fix isn't to try harder at the top. It's to go back down and build the levels you skipped. Protection first, then debt management, then your emergency fund, and then, on top of all of it, the wealth building that finally gets to grow undisturbed. Start where you are. If you have no protection, that's level 1. Begin there. If you're drowning in high-interest debt, that's the leak to seal next. If you have no emergency fund, that's your shock absorber to build. You don't have to do it all at once. You just have to build it in the right order, from the bottom up, so that what you build actually holds. Let me walk you through what happens when each level gets skipped, because seeing the failure modes is often what makes the order finally click. Skip level 1, protection, and you've built everything on sand. One major event, one health crisis, one loss of income, and the whole structure can come down at once, no matter how much you saved or invested above it. Skip level 2, debt management, and you're trying to build on a foundation with a constant leak. Every dollar you'd use for savings or growth gets siphoned off by interest before it can do anything, so you feel like you're working hard and getting nowhere. Skip level 3, the emergency fund, and every surprise becomes a crisis. You're forced to borrow or sell at the worst possible moment, undoing months or years of progress in a single bad week. And skip straight to level 4, investing, with none of the levels below it, and you've built the roof first. It looks impressive right up until the first storm, when there's nothing underneath to hold it up. Let me show you the two paths side by side, because the contrast is the whole lesson. Picture two people who both decide to get serious about money. The first one does what feels exciting. They open a brokerage account and start aggressively investing, while still carrying high-interest credit card debt and holding almost no cash. For a while it feels great. The account is growing, they feel like an investor. Then their car's transmission dies. With no emergency fund, they have to either sell their investments at whatever price the market offers that day or put the repair on a credit card at high interest. Either way, the foundation they skipped just cost them. A few more surprises like that, and they're back to zero, wondering why investing didn't work for them. It worked fine. The order didn't. Now the second person builds from the bottom up. First, they put protection in place so a catastrophe can't erase them. Then they get their high-interest debt under control, sealing the leak. Then they build a real emergency fund, so surprises become inconveniences instead of disasters. And only then do they start investing. But now, when the car breaks or the market drops, nothing forces them off course. The emergency fund handles the car. The protection handles the catastrophe. The investments just keep compounding, undisturbed for years. Same effort, same income, completely different outcome. Because one built the roof first, and one built the foundation first. The second person isn't smarter or richer. They just went in order. This is why I keep saying the sequence matters as much as the actions. Every one of these moves, investing, paying down debt, saving, getting protection, is a genuinely good thing to do. There are no bad ingredients here. But ingredients in the wrong order don't make the meal, they make a mess. A great investment made before you have an emergency fund can become a forced loss. A debt payoff made before you have any cash cushion can put you right back into debt at the next surprise. The rightness of each action depends entirely on what you've already built underneath it. That's the part most financial advice never tells you, because it's busy selling you the exciting top layer and skipping the boring, essential bottom ones. And remember why this foundation is worth the patience. It doesn't just change your numbers, it changes how your whole financial life feels. There's a specific calm that comes from knowing a surprise won't derail you. That's the emergency fund talking. There's a quiet confidence that comes from knowing your family and your income are shielded from catastrophe. That's protection. There's a sense of freedom that comes from knowing your money isn't all promised to lenders before it arrives. That's debt management. People with a strong foundation aren't just financially better off. They're calmer, steadier, and able to make decisions from a place of strength instead of fear. They're never one event away from panic, so they never make the desperate moves that panic produces. And on top of all that, their wealth building actually works. Because they're consistent, they're never forced to sell at the bottom, and more of every dollar gets to flow toward growth, uninterrupted, year after year. The foundation isn't the thing that delays your wealth, it's the thing that finally lets it grow. So tell me, which level are you actually standing on right now? Still exposed with no protection, fighting the debt, building the emergency fund, or finally investing on solid ground? Drop your level in the comments so I know where you're starting from, and we'll build up from there together. If this finally explained why your financial plan keeps falling apart, hit like so it reaches someone who keeps starting over and can't figure out why. And subscribe, because next time we're getting into why saving money alone isn't enough, and the silent force quietly shrinking your wealth every single year.